Engineering economics. This chapter discusses the elements of economics and the interaction between its various components. This is followed by an analysis of the need and scope of engineering economics. Economics is the science that deals with the production and consumption of goods and services, and the distribution and rendering of this for human welfare. The following are the economic goals: a high level of employment, price stability, efficiency, an equitable distribution of income, and growth. The flow of goods, services, resources, and money payments in a simple economy are shown in this figure. Household and business are the two major entities in a simple economy. Business organizations use various economic resources like land, labor, and capital, which are provided by households to produce consumer goods and services, which will be used by them. Business organizations make payment of money to the households for receiving consumer goods and services. The household make payments of money to business organizations. This cycle shows the interdependence between the two major entities in a simple economy. An interesting aspect of the economy is that the demand and supply of a product are interdependent, and they are sensitive with respect to the price of the product. The interrelationships between them are shown in this figure. It is clear that when there is a decrease in the price of a product, the demand for the product increases and its supply decreases. Also, the product is more in demand, and hence demand for the product increases at the same time. Lowering of the price of the product makes the producers restrain from releasing more quantities of the product in the market. Hence, the supply of the product is decreased. The point of intersection of the supply curve and the demand curve is known as the equilibrium point. At the price corresponding to this point, the quantity of supply is equal to the quantity of demand. Hence, this point is called the equilibrium point. If the income level of people increases significantly, then their purchasing power will naturally improve. This will definitely shift the demand curve to the northeast direction. A converse situation will shift the demand curve to the southwest direction. If, for instance, the price of television sets is lowered drastically, its demand will naturally go up. As a result, the demand for its associated product, namely VCDs, would also increase. Hence, the price of related goods influence of the demand of product. Over a period of time, the preference of the people for a particular product may increase, which in turn will affect its demand. For instance, diabetic people prefer to have sugar-free products. If the incidence of diabetes rises naturally, there will be increased demand for sugar-free products. If the cost of inputs increases, then naturally, the cost of the product will go up. In such a situation, at the prevailing price of the product, the profit margin per unit will be less. The producers will reduce the production quantity, which in return will affect the supply of the product. For instance, if the prices of fertilizers and costs of labor are increased significantly in agriculture, the profit margin per bag of paddy will be reduced. So the farmers will reduce area of cultivation, and hence the quantity of supply of paddy will be reduced at the prevailing prices of paddy. So the factors influencing demand the shape of demand curve is influenced by the following factors: income of the people, prices of related goods, taste of consumers. Influencing supply, the shape of supply curve is affected by these following factors: cost of inputs, technology, weather, prices of related goods. If there is an advancement in technology used in the manufacture of the product in the long run, there will be a reduction in the production cost per unit. This will enable the manufacturer to have a greater profit margin per unit at the prevailing price of the product. Hence, the producer will be tempted to supply more quantity to the market. Weather also has a direct bearing on the supply of products. For example, demand for woolen products will increase during winter. This means the prices of woolen goods will increase in winter. So naturally, the manufacturer will supply more volume of woolen goods during winter. In engineering economics, we have three types of efficiency. The first is the effective rate of interest. The second is discounting and inflation. In the effective rate of interest, the real or precise rate of interest earned on the principal over the course of a year is known as the effective rate of interest. When evaluating loans or investments, comparing effective interest rate aids in identifying the most cost-effective choices. In discounting is the difference between a money's present and future values. The present value of future cash flow is calculated using the discounting concept, which is crucial for assessing the long-term project's economic viability. Inflation is the gradual rise in the cost of goods and services. Because inflation has an impact on the actual value of future cash flows, it is essential for effective financial planning and economic reach. In order to assess the effectiveness of financial actions, the text makes use of ideas like inflation, discounting, and the effective rate of interest, because it enables a realistic comparison of the true cost of borrowing or the true return of investments. The effective interest rate is essential in order to ensure that financial resources are distributed effectively to alternatives that offer of the highest real return or the lowest actual cost. It goes beyond the stated nominal rate to account for the influence of compounding frequency. On the other hand, discounting is essential for evaluating the effectiveness of investments or projects that provide cash flows across a range of time periods. Discounting allows decision makers to effectively evaluate choices and rank those that offer the most value in today's terms by calculating the present value of future cash flows. This helps them to understand that money received sooner is often more valuable. Lastly, keeping long-term in financial planning efficient requires taking inflation into consideration. Over time, inflation reduces the purchase power of money. By including inflation rates into financial evaluation, it stops resources from being wasted on initiatives that could seem advantageous but ultimately don't reproduce tangible economic advantages. In engineering economics, we have the element of cost. Variable costs are those that change with the volume of production. These are direct material costs, direct labor costs, and direct expenses. Direct material cost of materials used to produce the product. Direct labor cost is the wages paid to workers directly involved in production. Direct expenses are expenses that vary with production volume. For overhead costs are fixed, meaning they don't change with production volume. This includes indirect material costs, indirect labor cost, and indirect expenses. Administration head, costs incurred in administering the business. Selling overhead, expenses for promotional activities and sales force. And distribution overhead, cost of shipping items to customers. Variable cost expense that change in direct proportion to output volume are known as variable costs. These expenses consist of direct labor costs, which are the wages paid to the workers who actively participate in the production process. The direct material costs, which are the costs related to the raw materials used to make the product. And direct expenses, which are those costs that are specifically related to production output, aside from direct labor and material costs. Conversely, overhead expenses are those that don't alter regardless of the shifts in output volume. In addition to administration overhead, which includes all business management expenses, selling overhead, which includes all promotional and sales force expenses, and distribution overhead, which includes the entire cost of shipping the goods from the factory to the customer's location. Overhead costs also include indirect material costs, indirect labor costs, and indirect expenses. The other types of costs or revenues are marginal cost, marginal revenue, sunk cost, and opportunity cost. Marginal cost is the additional cost incurred from producing one more unit of a good or service. Marginal revenue, the additional income generated from selling one more unit of a good or a service. Sunk cost, a cost that has already been incurred and cannot be recovered regardless of the future actions. Opportunity cost is the value of the next best alternative that is foregone when making a choice. The extra cost spent by manufacturing one more unit of an item or service is referred to as the marginal cost. It assists companies in determining if raising output profitable in general. It is advantageous to produce more if the marginal cost is less than the price at which the product can be sold. Conversely, the additional money received from selling one more unit is known as the marginal revenue. Businesses are urged to increase output until the two are equal because a large marginal revenue than marginal cost suggests that the possibility of a profit. A cost that has already been incurred and cannot be recouped is known as a sunk cost. This expense should not impact present or future decisions, but individuals sometimes fall into the sunk cost fallacy, continuing a project only because they've already spent time or money into it. Conversely, opportunity cost is the value of loss when one option is selected over another. This idea is crucial for decision making because it encourages people and organizations to think about what they are giving up when they make a decision. Making a logical and effective financial decision requires an understanding of these ideas. Simple interest. Simple interest is a straightforward method of calculating interest on a principal amount. It's determined by multiplying the daily interest rate by the principal by the number of days that elapse between payments. So for the formula of simple interest, for the meaning uppercase I, it means interest. Uppercase P is the principal or the capital, and for the lowercase I is the interest rate. And the n lowercase n is the interest period. So these are the formulas. I equals P times N times I, or interest equals principal times number of interest period times interest rate. For future worth equals principal plus interest. Then third one is F equals principal times 1 plus number of interest period times interest rate. Interest rate. So here I prepared some questions. Number 1 is which of the following is a key characteristic of simple interest? A. Interest is calculated on the principal and accumulated interest. B. Interest is calculated only by the original principal amount. C. The interest rate changes over the loan term. D. Interest is compounded multiple times within a payment period. So the answer here is B. Which of the following is not explicitly mentioned as an economic goal in the text? A. Price stability. B. High level of employment. C. Increased international trade. D. An equitable distribution of income. So the answer here is which of the factors which of the following factors is stated in the text as influencing the shape of the demand curve? A. Government regulations. B. Production of costs. C. Income of the people. D. Availability of resources. The answer is C. Income of the people. When comparing loan options with different repayment schedules and interest rates, which concept helps determine the most efficient option for minimizing the cost of borrowing? A. Simple interest. B. Nominal rate of interest. C. Discount rate. Or D. Effective rate of interest. The answer will be letter D. Effective of rate interest. In engineering economics, which concept is used to efficiently compare projects with cash flows occurring at different times? Inflation, simple interest, discounting, or nominal rate of interest? And the answer will be C, discounting. Why is it important to consider inflation when evaluating the economic efficiency of a long-term project? A. Inflation increases the purchasing power of money. B. Inflation has no effect on economic efficiency. C. Ignoring inflation can lead to an overestimation of future benefits and an underestimation of future costs, leading to inefficient decisions. D. Inflation only affects simple interest calculations. The answer will be C. Ignoring inflation can lead to an overestimation of future benefits and an underestimation of future costs, leading to inefficient decisions. Which concept allows for a standardized comparison of the actual return on investments, even if they have different compounding frequencies? A. Simple interest. B. Nominal rate of interest. C. Compound interest. Or D. Effective rate of interest? The answer is D. Effective rate of interest. Which of the following statements best describes how discounting contributes to efficient economic decision making? A. Discounting calculates the interest paid on a loan. B. Discounting determines the future value of an investment. C. Discounting allows for comparing the present value of future cash flows. D. Discounting measures the rate of inflation. The answer is C. Discounting allows for comparing the present value of future cash flows. Explain how the concept of the effective rate of interest contributes to making efficient financial decisions. By offering a consistent metric for comparing the true return on investment or the true cost of borrowing, even when those loans are or investment have different nominal rates and compounding frequencies. The idea of the effective rate of interest aids in the process of making wise financial decisions. What are the two primary classifications of costs, and what are the components of each? Overhead and variable expenses are the two main categories of costs. Direct material cost, the price of the resource used to make the product. Direct labor cost, the pay given to the employees directly involved in manufacturing. And direct expenses, other costs that fluctuate with production volume, are examples of variable costs. Indirect material cost, indirect labor cost, indirect expenses, administration overhead, costs associated with running the business. Selling overhead is the cost associated with hiring salespeople and conducting promotions. And the distribution overhead are the costs associated with shipping goods to clients, are all the considered fixed overhead costs regardless the production volume. What is the annual rate of interest if 265 pesos is earned in 4 months on an investment of 15,000 pesos? For the DEN is the interest period. So we have given 4 months out of 12 months. So if we so basically it's 1/3, no? And then formula we will be using is interest rate equals interest over principal times interest period. So we have 265 pesos over 15,000 times 1/3. So we have a 0.053 or 5.3% of a annual interest rate. Determine the exact simple interest on 5,000 pesos for the period from January 15 to November 28, 1992. If the rate of interest is 22%. For the given principal, we have 5,000 pesos, and for the interest rate is we have 22%. For January 15, excluding January 15, until the end of January, we have 16 days. For the February, we have 29 days. March is 31 days. April is for 30 days. May is 31 days. June for 30 days. July for 31 days. And August for 31 days. September for 30 days. October for 31 days. And November 28. November for 28 days. Summing this up, we have 318 days. For the formula, we'll be using the principal times interest rate times interest period. For our capital principal, we have 5,000 times the interest period, 5,000 times 318 days divided by 366 days. And for the interest, we have 0.22%. If we sum this up, the answer is 955.74%.